The spread of the coronavirus beyond China has dramatically hit global growth forecasts and stock markets, but central banks are doing their best to restore confidence. An update on our expectations in this volatile economic environment. A month ago, we talked about the glass half full scenario, but also the risks to this outlook in the wake of the bushfire tragedies and the coronavirus outbreak. Now, the extent and breadth of the virus impact is far clearer and has doused hopes for the gentle turning point that our Reserve Bank had been referring to. The fact that central banks around the world have seen the need for a coordinated response shows the gravity of this demand and supply shock. We heard from the US Federal Reserve on Friday committing to imminent rate cuts, with 0.5% delivered last night. The Bank of Japan added liquidity to their markets on Monday, and the RBA played one of the few remaining aces in their hand yesterday. So, more central banks around the world will be following suit, with rate cuts and other measures over the coming days. Just 2 weeks ago, stock markets were blasé about the virus, and indices were trading at record highs. But here and around the world, a 10 to 15% fall has eradicated most of the last 6 months' gains, with a temporary bounce from the lows thanks to the central bank's actions. Now is not the time for brave calls on where stocks will head in the short term, but the market is decisive on interest rate expectations, with 10-year bond yields down to record lows here and in the US. So, a prolonged period of low interest rates is now expected to last even longer. Our 10-year bond yield is down to 0.75%. News on the coronavirus and central bank actions to deal with it is overshadowing economic data, although the latest economic news from China on their manufacturing PMI survey was hard to ignore, a lower read than the GFC, with similar falls for services. The GFC was a V-shaped recovery, as the chart shows. Who knows what this recovery will look like? But global growth and China's growth rate will be close to zero this quarter at best. Australia's growth rate is also in focus, with 2019 final quarter GDP to be released today, which should show around 2% growth here at year end. But as we said last month, this quarter is looming as a negative read for GDP, and now suddenly the chances of a second quarter contraction are much higher. So our first recession for 29 years is the risk, hence the RBA cut. Importantly, the federal government is also set to assist now with fiscal stimulus to manage this risk. Fortunately, during all this drama, the Aussie dollar has behaved well, continuing to fall, down to a low around 64.5 cents. Again, not an environment in which to make bold predictions, but the lower Aussie dollar will help to cushion the blows from overseas. And for now, our economy still has a solid housing market, making further gains in February, a trade surplus with a positive outlook for resources, especially once we get past the virus, and a AAA credit rating with relatively low government debt. So the government can step up to the plate with meaningful fiscal support. Beyond this, the jobs market is looking less positive than a month ago, so we will keep a close eye on developments there, and obviously any developments around the virus and its impact on the global economy. In short, it's a risky period, and we can expect more central bank and government actions to address those risks. And that's the market update from Leveraged.